The 1907 bankers' panic was a severe 3-week financial crisis. The crisis resulted in bank runs, a near 50% drop in stock values, and a major recession. It was only halted when financier J.P. Morgan organized a consortium to inject liquidity, highlighting the need for a central bank. President Woodrow Wilson came into office in 1913, and he placed a lot of pressure on Congress to create a central bank, which was a top priority of his administration. The following year, the Federal Reserve Bank began as a system of 12 independent regional reserve banks to provide liquidity to the banking system. However, it was a decentralized system where each bank would have a governor and be a caretaker of its own region and would set its own priorities and follow its own economic philosophy. The governors were political appointees who were sometimes unqualified. Coordinated action would be difficult and decisive action was rare. For more than a decade, one governor had made the system function as a whole, Benjamin Strong, governor of the Federal Reserve Bank of New York. He was highly respected around the world, and his views generally held sway over the other regional bank governors. The Reserve Bank of New York oversaw roughly 1/3 of the nation's financial assets, which gave Strong powerful influence on the entire banking system and the other governors. He used open market operations, which is the buying and selling of U.S. Treasury bonds, to adjust the money supply. He supported the gold standard, but he did not follow it mechanically. His priority was price stability and to ensure sufficient transaction money was in circulation to prevent the use of scrip, or certificates, as a substitute for dollars. In the 1920s, that was a new and controversial idea. When Strong died in 1928, there was no one to replace his leadership and economic insight. The Federal Reserve System became fragmented. The money supply had lost its defender. To understand what followed, you must understand one variable: the velocity of money. The velocity of money is how fast money changes hands. Another term is transaction money, or the amount of money available for transactions. The money supply combines factors such as all the money in circulation minus idle money, plus the effect of changes in the velocity of money. If the money supply is insufficient to meet the requirements of all transactions that are to be done, then alternatives need to be found, like scrip or bartering, or some of the transactions will be canceled. In 1929, the velocity of money was relatively high, but starting to slow down. Farm incomes had been under pressure for years. In August 1929, economic activity began to contract. Then the Federal Reserve raised interest rates. In October, the stock market collapsed. Confidence fell. Spending dropped. Investment slowed. Loan demand declined. Banks became cautious. The velocity of money fell. The money supply needed to expand. But that would not happen. In 1930, the first and smallest wave of bank failures occurred. Many at the Fed thought that the widespread bank and business failures were a good thing, a type of economic Darwinism. These were known as the liquidationists. Weak banks should fail. Weak businesses should fail, even if the business failure was caused by a bank failure. The economy would cleanse itself. Many warned this approach would destroy the financial system. The point of no return had not yet been reached, but there was little time remaining to save the economy. The system could only endure a limited number of bank failures because with each bank failure, many businesses would have to close because their operating cash was gone. The Federal Reserve needed to act as a lender of last resort by helping the member banks and non-member banks with cash injections to restore their cash reserves. Cash could be loaned to the bank by securing the loan with bank assets. Some of the regional reserve banks failed to act, while others acted aggressively to help the banks. The New York and Atlanta Reserve Banks acted decisively and boldly, which resulted in a much lower bank failure rate and reduced the resulting economic impact in their regions. One obstacle loomed over the problem. The amount of cash that the Federal Reserve banks had was limited. To get more money, it would have to be printed, but, by law, at least 40% of every dollar in circulation had to be backed by gold reserves. That limit was nearly reached in 1930. Lowering interest rates to ease borrowing costs might cause the banking system to run out of money. Deflation began a negative feedback loop. Manufacturers and merchants got paid less and less for their products, which meant that paychecks had to be regularly reduced. Because paychecks were being reduced, downward price pressure was put on everything. It also resulted in higher effective interest rates as loan payments are being made with money that was worth more than the money that was borrowed. Paying loans back kept getting harder and harder. Loan defaults remained high. Saving money was rewarded as that money would gain in value if you held on to it. By 1933, 1/3 of all U.S. banks were gone. $7 billion of deposits had vanished. Tens of thousands of businesses lost their working capital due to bank failures. Across the country, there was not enough cash to conduct ordinary transactions. Hundreds of communities issued emergency currency in the form of scrip or certificates. The city of Chicago issued Chicago Clearinghouse certificates to city employees, which were very difficult to cash. Foreign investors were redeeming dollars for gold. Inside the Federal Reserve, only New York and Atlanta Federal Reserve regional banks defended the shrinking money supply. Interest rates were raised to defend the gold reserves. The economy was on fire, and raising interest rates was like pouring gasoline on it. Banks hoarded cash. People hid cash at home. The velocity of money kept falling. Unemployment peaked in 1933 at 25%. President Hoover had been unable to find a way out of this mess. President Roosevelt was inaugurated on March 4, 1933, and he had a plan. 5 days later, Congress passed the Emergency Banking Act of 1933, and the President signed it. The act authorized the Federal Reserve banks to reopen some closed banks and issue additional currency to meet demands. The 40% gold requirement was now given an exception. Additional currency could be backed by good quality bank assets rather than just gold. On April 5, 1933, Roosevelt issued an executive order which outlawed most gold ownership. Gold reserves increased and were converted into dollars. But that was not enough to reverse the damage. The money supply was still a drag on the economy. The Gold Reserve Act was passed, which meant that only foreign central banks could now redeem gold. Also, the provisions of this act effectively ended any real constraint on the gold-to-dollar ratio. A lot more money could now be added to the economy. Ending the deflationary cycle. The Roosevelt administration increased the number of dollars it took to buy an ounce of gold by 69%. The gold ratio change was inflationary, which ended the deflation trap. The Reciprocal Trade Agreements Act of 1934 improved foreign trade. The new gold-to-dollar parity made the dollar cheaper for U.S. goods, which helped farmers to export their excess crops. It also helped U.S. manufacturers to expand production to meet foreign demand. Gold began to flow back into the U.S. Interest rates were lowered. Loan defaults dropped. Loan demand increased. 9,000 banks failed in 1933. That dropped to 61 bank failures in 1934. And just 26 banks failed in 1935. In 1934, the economy grew by 11%. In 1935, the economy grew by 9% and 5 million Americans were back to work. The U.S. ran a strong trade surplus. which would be settled by more gold entering the U.S. America now had a dominant global position in central bank gold reserves, and by 1939 would hold approximately 60% of all global gold reserves. In 1935, the Federal Reserve was reorganized into a centralized institution. Policy could now be coordinated, scaled, and executed rapidly. The FDIC was created to ensure bank deposits. Economic growth surged until 1937. The 1937 to 1938 recession was quite severe, with a 10% drop in GDP, a 32% drop in industrial production, and the unemployment rate shooting up to 20%. The severity was again amplified by a contraction in the money supply. The Fed policymakers saw that banks held extra money in reserve. These reserves were held in response to the near-death experience by bankers during the previous years. The Fed suddenly doubled reserve requirement ratios for banks. The banks now had little reserve margin before they would be in violation of the new requirement. Money flowed out of the economy and into bank reserves as banks severely cut back on issuing new loans or renewing old loans. The Social Security payroll tax also debuted in 1937, withdrawing more money from circulation as this money was set aside for the future. At this time, the gold inflows were substantial, but without consulting the Federal Reserve, the Treasury decided to sterilize the gold inflows, which means they did not convert them into more dollars. The economy went into a steep dive. The recession ended after the Fed rolled back reserve requirements. The Treasury stopped sterilizing gold inflows, and it desterilized all remaining gold that had been sterilized since December 1936. The recovery from 1938 to 1942 was spectacular. In summary, the Great Depression began as an ordinary recession, not much different than the 1907 recession. Policymakers took no action. Without Benjamin Strong or J.P. Morgan to save the day, the economy crashed to such an extent that the Fed did not have enough cash to insert enough liquidity to relieve the now massive money supply shortage. Nothing could be done to fix the economy until a way could be found to overcome the gold standard limitation on issuing more money. President Roosevelt came into office with a solution that greatly expanded the money supply and triggered a strong rebound in the economy. At the same time, the solution maintained confidence in the dollar and expanded gold reserves.